Hello and welcome to this week's Market Thinkers discussion. My name's Jamie Nemtsas and I'll be joined by my business partner, Drew Meredith, and Phil Strano from Yarra Capital. Hello, Drew. Hello, Phil.
Hey, Jamie.
Hi, Jamie and Drew. Thanks for giving me this opportunity. Great.
No problem. Every week we bring insights from portfolio managers, CEOs, thought leaders and investment experts in the attempt to bring you, the investor, closer to the coalface. The coalface that Drew and our team sees every single day. For the new listeners, Wattle Partners is a fee-for-service based Melbourne wealth management firm, and as name suggests, we manage wealth. Essentially portfolios of individuals, retirees, trusts, funds, and a few other different types of pools of capital. We tailor portfolios to the client and what their risk appetite or return objective is, and any overlay they might have, like ESG. We use a whole heap of different investments, from direct shares to managed funds to private investments. Essentially, this business was founded by Austin Donnelly back in 1973. Austin had owned dealer's license number 1 in Queensland, and we think he was the first fee-for-service and independent advisor. And we're very much the same now. In this session, we're happy to welcome Phil from Yarra Capital, a specialist fixed income and credit manager. Phil is. He runs the Yarra Capital Absolute Credit Fund, and we've known Phil for about 9 years. He's worked previously at VFMC, and for people that don't know, VFMC is Victoria's own sovereign fund. I think it's got in excess of $50 billion, Phil.
I think 60 odd now. Yeah,
$60 billion. Yeah. $60 billion. It's rarely talked about. In fact, Wattle Partners used to, with VFMC, manage another government agency's money for 3 or 4 years. So we know Phil and his team really well. The idea of this session is to make sure that you guys are involved. So please ask questions throughout the session. I'll talk about what the session looks like. First, Drew will introduce how we use this product within our portfolio and where it fits. I'll ask Phil 10 quick questions, quick fire questions, hopefully under a minute in total. And then we'll go into some explanation of what is the fund, how does Phil manage the fund, and some education around what is credit and what are the instruments that Phil has within his fund. As today is the 11th day, 11th month, we'll also pause for 1 minute at 11 o'clock and pass our respects for soldiers that fought for our nation. So, Drew, do you want to just give us an intro of where we use Phil's fund within our portfolio and what attracted us to using Phil's fund?
Of course, thanks, Jamie. As we probably highlighted a few weeks ago with another bond strategy, bonds are kind of misunderstood and underinvested in Australia. They seem to still be. In some global pension funds, they might have 40 to 50% in traditional bonds and credit, whereas in Australia, most SMSFs can have as little as 5 or 10. But they're very straightforward. They're loans to businesses and governments. As Jamie said, Yarra is a little bit different. Where, as the name suggests, they invest in credit, and I think we'll define that a bit later. But basically, credit is just lending money to businesses rather than to governments or other institutions. And in terms of why we added it, it's pretty simple. We're trying to replace lost income that we've seen over the last 12 months or 2 years from other parts of the portfolio. So last week, the RBA cut the cash rate to 0.1%, sent term deposits everywhere lower, 5 years under 1% now. And NAB reduced its dividend yield, which is now about 4%. Whereas credit, as Phil will discuss, we can get anywhere from, I think, 3 to 7% in income, depending on credit ratings, with substantially less volatility and capital risk. And I think the big difference there is that the payments that come on credit and bonds are not discretionary, like a dividend that can be changed at the decision of a board. The second purpose, of course, is getting in diversification away from across different companies and across different parts of the capital structure, which we'll also go into a bit later. Why we found Yarra, I think, is experience is key in bond and credit markets. And as Jamie mentioned, I think, can I call you a lifer in credit, Phil? You spent most of your career in bonds and credit.
No, I think that's probably fair. Yeah, I think the white hair will probably prove that too.
So who you know is just as important as what you know, I think, or maybe they both have an important role in credit. So we'll go to Jamie with the quick questions.
Okay, here we go, Phil. 10 quick questions. 1, 2, 3, or 4 word answers, please. What's the best stock or investment you have personally bought?
The funny enough, credit security, the NAB which are a NAB perpetual.
Bought them at a discount, I assume?
We traded as low as in the 70s back in March, April, and NAB's on course to redeem them at some stage next year at 100. So pretty good return.
What's the investment decision that you most regret over your career?
Sold my townhouse in 2009. Yeah, made a tidy profit, but left plenty on the table.
Name one belonging from your youth you still wish you had today.
My security blanket, walking around as a kid, would have come in handy in March, April, that's for sure.
It would have been great. Pineapple on pizza?
It's had in heritage, so I think you know the answer to that one. It's going to be a definite no.
So let's imagine you're retired today and you can only hold one stock or one investment for the whole of your retirement. What would it be?
I think anything for soft commodity related. So you certainly look at the Australian market, you look at the burgeoning Asian middle class, demand for Australian foodstuffs and the like. Something like a Select Harvest or a Tassel with that kind of fundamental underpinning.
Yeah, got it. What is the best piece of business advice you've ever received?
The power of compounding. Stay invested. So I think a lot of people have claimed that, but I think Warren Buffett's my go-to on that one.
Yep. Best investment for Armageddon: gold, crypto, cash, government bonds.
Definitely gold, because it can't be replicated or printed away.
Okay. The best read you can recommend.
There's a book I read a couple of summers ago called Lost Connections by an author called Yan Hari. Basically looked at the epidemic of depression and anxiety in this technological phase where I think we're all so connected, but we're really disconnected because we don't really have this kind of face-to-face meetings. And funny enough, 2020, not many of us have face-to-face meetings, have we?
Yeah,
so,
good point.
Yeah.
Must read it. Best region to invest today: US, Asia, Europe, or Australia?
Oh, I'd be parochial here, but I definitely think Australia. I mean, if you look at Australia, the fact that it took a pandemic to give us a recession after 30 years.
Yep.
I think the other thing that's in our favour is that we're still a relatively young country. We've got this massive natural endowment of resources that gets spread across 24 million people, and that in itself provides a real stability to economic growth, which you don't necessarily have elsewhere in the world.
A great answer, Phil. And the last one, the one red flag for all investments.
Inconsistent messaging from management. So we often get the occasions where you get management that will tailor their message depending on who you're talking to. A lot of the times they'll tell equity investors one thing and debt holders the other. Obviously, that's a clear no-no for us.
Yeah, that's interesting. So thanks for those questions, but maybe that's a lead-on question. Yarra Capital has equities and has fixed income. So do you use your analysts on both sides to assess the investments that you're going into, or is it just your analysts that you have access to?
No, I mean, one of the key advantages of Yarra and why it was attractive for me to leave VFMC with the strategy that I ran there and come to Yarra was the ability to actually leverage off the fundamental research went on at Yarra. The fact that we're not just a 5-person fixed income team, but rather we're part of a broader 18-person investment team when you include the bodies in the equities team. And we do a truckload of fundamental research into Australian corporates. And that gives us a unique opportunity to kind of construct those portfolios, only focusing on where it makes sense to invest.
Can you give us a bit of background on, and Drew, I'm stealing your thunder here, but it's a bit of background on Yarra. Where Yarra's not a name that's been around for 30 years, so can you just give us some background about Yarra Capital?
So Yarra Capital is the old Goldman Sachs Asset Management. So it's management buyout in 2016.
Yep.
And formulated in January 2017. So there's a long heritage, Goldman Sachs heritage, and before that JB Weir, that extends multiple decades. So that heritage came across, and certainly I joined in May 2017.
And had a very institutional focus originally. Was it a lot of managing for pension funds and industry funds?
Yeah, certainly more institutional, but we are obviously increasing our efforts in the retail space.
Yeah, I think. Do we go from the top, Jamie?
Go from the top.
Can you just talk us through generally credit as an asset class, and we saw, I think, government bond prices spike something like 20 basis points yesterday. So compared what you're investing into compared to a traditional government bond.
Yeah. Okay. So I mean, probably the simplest way to explain credit to the retail audience is that what we're trying to do is basically, rather than you funding the banks in return deposit and letting the banks earn the spread, what you're doing here is giving money to managers like us to basically go and earn the spread for you. Okay. Yeah. That's probably the simplest way of doing it, rather than you putting into a term deposit, which right now is not much. You basically putting it into a fund like ours, so we can go and lend it to corporates and earn that spread that the bank would typically make. And give to equity holders, right?
So the mortgage rate's at 3%, and they're paying us in a term deposit 0.7. So
correct.
2.5% disappears.
That's correct. Absolutely. So we're capturing that, and that's what we do every day of the week.
How big's the market for credit in Australia?
So in our opportunity set, in terms of the multi-sectors that we look at, it's a $2 trillion opportunity set. So it's roughly the same size as the ASX. So it is very, very substantial, and we have got ample opportunity to grow and find those risk-adjusted returns that provide that defensive income for clients.
Yeah, and the fund invests into some private and public credit?
Correct, yeah. So the fund has got access to private debt. It is capped at roughly 20%. So we can manage the broader liquidity requirements, still provide clients with substantial liquidity, but be in a position where we can pick the eyes out of the private debt market as well and have it as an active part of the sleeve, be able to accrue some of the illiquidity premium that's available in that market to boost the carry and generate the defensive income that clients need.
And private compared to public, so is there an exchange for bonds where you can buy and sell them, or?
Yeah, so really the difference between private and public, the way I put it is anything public is effectively traded over the counter or ASX. So they're traded on the ASX or through Austraclear. The private debt space is more traded on a bespoke basis. So it does trade, it's just not as liquid. So as long as you're conscious of that and you're getting paid for that less liquidity, and it's a part of your portfolio, you can easily manage the liquidity requirements and get the spread pickup that clients need.
So to take one step back for the listeners, credit is just simply when a company, either public or private, wants to raise money or borrow money, and they've got a number of different ways they can borrow it. And credit is essentially one of those ways. So if you talk about company A and the company A is worth $10 billion and they need to raise another $1 billion, they might issue notes or some kind of note. And then essentially that company, if you buy those notes, that company owes you money.
So to put it in context, so I mean, most of the ASX listed names that your clients would be familiar with, household names, whether it be, say for instance, someone like Coles or Woolworths or Tabcorp.
Yeah, let's take Woolworths for example. Yep.
Woolworths. Okay, so Woolworths would have bank debt, which they would get from the banks, but they would also have capital markets debt. So they would issue bonds out in the market, okay, and they would pay a spread, a credit margin over a bond rate to get an overall yield. Okay, that's available when you buy those bonds. And so it's a viable place of return. And the other issue is that the market is growing, and it's growing because the banks have been, the regulators after the global financial crisis decided that they needed to improve bank balance sheets. So they sort of constrained the bank's ability to actually lend money to corporates. And it basically means that they've been losing share. And that share has been coming to the capital markets and has been institutionalised. So people like us have more opportunities to actually put that money to work now. And the other aspect of that is that the banks have also been told they need more capital, which also means that they've increased the supply of bank credit, higher yielding bank credit, which has also been a very attractive part of portfolios.
So you don't need more companies taking on more debt to have more opportunity. It's more that the banks are pulling out that's creating more opportunity.
Well, correct. I mean, we all know the size of bank balance sheets are huge, right? So, you know, it doesn't take much. So, you know, risk-weighted assets, the overall assets that the banks have held in terms of risk-weighted terms, which is basically the stuff that we're investing in, has fallen by about 10 percentage points over the past, ever since the global financial crisis. And that's basically corporates that then needs to find access to debt elsewhere, and majority of that has gone into the capital markets.
Okay, so just so back to the Woolworths example, Woolworths would have what they call a capital stack, and at the top up here is when they can go to the bank and say, hey, we're Woolworths, we want to borrow a tranche of money, and they would pay a couple of % on that, and then you keep going down from there, and so the first tranche that the bank lent the money, if the company was to go bankrupt, they're first in line, right? They're number one in line if the company goes bankrupt for all the assets. And then it goes down from there. So we're not, this fund essentially doesn't give us the bank debt. What it does is give us stuff further down on the pyramid, which we still think, or you still think, not we, you still think is very, very secure for the type of return that it's providing. So rather than 2%, it might provide 6%, and in terms of margin of safety, rather than being first in line, it's third in line, for example. And that's essentially how we see it anyway. We see credit as being those ones not first in line, being second, third, fourth, or fifth in line, and essentially offering a rate that's 2, 3, or 4 times higher than the first senior secured.
Yeah, so it's the way I look at it is that we find value across all of that stacks.
Yep.
Okay, so you know, roughly a quarter of the portfolio ranks pari passu with the banks.
Yeah. Okay.
So we're first in line with the banks at about a quarter of the portfolio.
Okay.
Now, other parts of the portfolio, we make that sort of I don't want to say arbitrage, but basically we agree to be sort of second in line because we know we're still an incredibly secure position. And there's a kind of misalignment in pricing, or because of just the market is just not as well informed, where we can make outsized returns for the risk that we're taking. So you know, we're in the business of getting paid for the risk that we're taking. First, that's the first, second, and third principle in every investment that we do.
I think the big one there is that equity sits right at the bottom too. Sorry, Jamie.
Yeah, so you've got the equity stack below you, right? And in the overwhelming cases, and March and April was a classic example, is that equity will typically always heal the structures. Okay, so most of the ASX listed corporates, literally all of them, I'd say more than half raised equity during that period just to take credit risk off the table. You know, Intertech Pivot was a classic example, which would be a name that is familiar to a lot of people. You know, we were buying that at a distressed yield of in excess of 5%, right, back in March, April. Yesterday, they went and they announced their results, reasonably steady results from a credit perspective, and they've gone and tendered the bonds at 2.1%, right? Yep. And we bought it at 5% in March, April, and even up until yesterday, it was still trading at 2.5% yield. So, I mean, this is the kind of work that we do every single day in a portfolio context. You've got significant diversity, and you're literally trying to find the pockets that provide that kind of defensive income and overall add to a very defensive portfolio. Right?
So something that we learnt many years ago is that for credit managers, and we kind of learnt this off a distressed credit manager, that every credit line, every instrument is fundamentally different from the next instrument. So due diligence into each and every investment that you make is really, really important. So where do you rank? How does it get triggered? What's your rights? Is that so? That's kind of knowledge, right? Unique knowledge. It's not like you can just pick up a ASX research report, read 300 words, and you get what the company does or where you rank because you're just equity. When you're dealing with credit and debt, there's so many of these instruments, and understand no one publishes the credit stack or the capital stack. Then you know you've been in it for a long time. As Drew said, you're a lifey. Do you have a team around you that does all this due diligence on each and every investment that you make? How do you approach that? Do you have a team of lawyers that help you out, or is it pretty vanilla in the Australian market where you're investing into kind of mainstream credit?
Well, it depends on what you're looking at and which segment of the market. So obviously we specialise in Australian domicile credit overall, and we've got access to multi-sleeves to play in. Obviously some are a bit more complex than others. So it's really horses for courses. So yeah, we do have in-house legal, and we use them when we require.
Yep.
But yeah, in terms of due diligence, it really depends on what you're looking at. So if you're looking at investment grade corporate that meets your return hurdle, in most cases that doesn't require as much due diligence as say something that's sub-investment grade or more structured or has a first lien mortgage over it. So it really depends on what you're looking at. So yeah, really. I mean, I am a lifer. 20 years of doing nothing but analysing credit and the varied structures. It's a specialised skill set, no question.
It's because it's contract, isn't it? When you have a loan, you have a contract, whereas when you buy a stock, you just own a stock that someone else can trade with you.
Yeah, you've got terms. You've got terms that need to be abided by, and those terms can vary significantly. And what's important is that if you're giving up something and loosening a term for a corporate, you've got to make sure you're getting paid for it, one. And two, you've got to make sure that you're still buying a defensive position. Okay. There are from time to time investments offered up in the fixed income world that pretend to be credit, but if you look underneath the hood, it's kind of equity risk. So they're trying to hoodwink you in getting paid a fixed income return for taking on significant equity risk, and they're not deals that we want to do, and we don't do them.
I think maybe a reasonable question would be what's your target income or target return for the portfolio, and what's it yielding at the moment?
Yeah, so currently it's yielding about 3.7%. Okay, so the target is to earn 300 basis points over cash.
Cash is zero.
Cash is effectively zero. So, I mean, obviously we are targeting those that try to get a portfolio blend of assets anywhere from, roughly 200 basis points over to 400 to 500. At all times being very discerning what goes into the portfolio and making sure that we're getting paid for the risk we're taking. Right?
It's almost a dividend yield on a bank, but with some security or preferential treatment in the event of a default of any of these companies is what you're getting.
Without the capital risk.
Yeah, without. Yeah.
Yeah, correct. So you're effectively getting a bank divvy right now, and without the capital risk associated with banks. Now, I mean, I'm not a bank equity analyst, but given where where basically overall yields are now, where the cash rate is right now, obviously bank profitability now and going forward isn't what it was in the health index. Right. Yeah. So it kind of lends itself to even say bank credit, whether it be being actually more attractive than bank dividends right now.
Yeah, less aggressive banks.
That's the important thing that you were trying to say, Drew, is essentially if you've got a bank equity, and everyone for the last 10 years, if you're retired, you've owned banks because of the dividends. When they want to cut the dividends, they can just cut it 100% and you don't get a dividend. But when you have a credit instrument against a bank or something else, then they're contracted to pay each quarter or each half year. And if they don't pay you the dividend, then essentially they're in default and they've got a whole heap of serious issues. So for retirees that are essentially looking for not just the amount of income, but the security of income, then credit has really interesting fundamentals that should be considered when building a retiree portfolio.
Yeah, well, I mean, you won't get me disagreeing with that, obviously, but you do have that equity piece that protects you, right?
Yeah.
So banks are reducing dividends for a reason. I mean, they're obviously trying to make sure that they remain very well capitalised during this period, and they're trying to remain by remaining well capitalised. It means they're protecting the position of credit holders above the equity position. Okay, so across all of the bank capital stack. Equity is basically nourishing and supporting the tier 1 securities, the tier 2 securities, and bank senior. Right? So we have a lot of security by the fact that they're retaining cash.
I think we're about to tick over to 11 o'clock. I had a query around how important credit rate or external credit ratings are to your decisions, or do you kind of overlay that with your own internal?
So
maybe think about that, Phil. It's good. So we've got 10 seconds. We're going to just spend a minute silence paying our respect for the fallen, and we'll be back in a minute and Phil can answer that question starting now. Thanks everyone for doing that. Obviously, we live in an incredibly lucky country where lots of men and women gave their lives over the last 100 years, especially World War One. So Phil, back onto it. Answer that question.
So obviously we use multiple sources. So external ratings are helpful, whether it be S&P, Moody's, or Fitch. But primarily we do our own internal credit work. Okay. Yep. So I've discussed before that we have an 18-person investment team that does nothing but understanding Australian fundamentals of corporates, banks, asset-backed RMBS structures, you name it, and that's incredibly powerful. We model 100 listed and unlisted issuers in the market on an ongoing basis. Which provides us a really strong template in which to understanding where the poor value is and where the really good value is, and we do that constantly. So constantly updated through reporting seasons and any events that meaningfully change our views.
So you'd look at like what a A-rated bond should be paying, compare it to what the company's doing, find out what the reason is, and you almost see an arbitrage if you expect it to be upgraded or if it's giving too much of income for the amount of capital risk that you think is there.
Yeah, and I mean ultimately for us, the March-April example was classic where effectively a lot of issuers that had some COVID clouds around them, which we knew would basically be healed over time. The REIT space, for instance, or the airports. Obviously, a very disruptive year and problematic, but one that has been borne by equity, right? Not credit.
Something we saw in the preference share market as well, where the preference shares fell incredibly quickly, but also snapped back to the previous the spreads snapped back quickly.
What drives all that, Phil?
So look, March-April was that once in a 10, 12-year event. I guess I've seen two of them. So the GFC and this one here in terms of the pandemic. I definitely think that the sell down in bank credit basically was a reflexive from investors who basically remembered back to the GFC and thought that it was going to play out the same way. That certainly wasn't our view. And we were actively buying during that period. From our perspective, regulators have done nothing but clean up bank balance sheets for the better part of 10 years, to the point where they would be able to withstand a period like this quite easily, and that's exactly what happened. Banks have absolutely loaded with liquidity. They've got so much liquidity, it's ridiculous. You only look at like 11 AM rates are effectively zero right now, and in terms of the cash rates that we get from for investing in short-term securities in terms of the banks. You've got bank senior spreads are the lowest they've been since 2007. So banks have just loaded with liquidity and hasn't been a credit issue at all, and it's just been a fantastic source of return for portfolios. So I think one of your questions you guys had before was talking about bonds selling off. I don't think I really covered that in terms of duration.
Is that a flood of sellers or people just wanting cash?
Well, effectively you had the vaccine issue, so it's effectively the risk on. Recently, the risk on, and but what it does point to is the underlying risk in traditional fixed income portfolios with long duration, which I don't think investors really understand the risk that's there. There's not a lot of protection in those portfolios anymore. And I think what you saw last two nights is that they lost 70 basis points in performance, the Bloomberg composite this is, and still only yielding roughly about 70 basis points overall. Yeah. Right.
So you lost a year full of income in 10 months, effectively.
Yeah. By contrast, we don't have any interest rate duration, so we're not exposed to rates going higher. If anything, our investors are actually insulated from that because the returns actually go up as rates go up because we're floating rate. Right. So all our interest rate duration is hedged. By comparison, those traditional managers have got that risk is actually growing because governments are actually issuing more and more longer dated bonds and actually increasing the risk underlying those portfolios.
That was the concept we discussed with Franklin, who have a short duration bond strategy where you compare it to government bonds that have, they call it 7-year duration or 7. So if interest rates go up 1%, they went up 0.7% or 0.2%, so 20% of the way there, you can lose 7% of your capital in that.
Yeah, correct. And I think that's poorly understood in some segments of the market, right, in terms of the underlying risk and what they're looking at.
So for clarification, Drew and I, our advice to our clients in the last 12 months is to basically cut duration to more or less 0, or if not within a year. So can you tell us about mortgage-backed securities? There was a lot of conversation around GFC about mortgage-backed securities, and it seems like any time that word comes up to our clients, they get quite concerned. And I understand within your portfolio you hold mortgage-backed securities.
Yeah, look, they shouldn't be concerned. I think in terms of the Australian market, the Australian housing market, there's significant difference between that and what your investors are, well, our investors are actually worried about in terms of headline risk going back to the GFC and predominantly the US housing market. It wasn't ever a dynamic of the Australian housing market. Their market is non-recourse, so you had that thematic called jingle mail where people were posting their keys back in the US. That never happened in Australia. Our market is recourse, and you've got mortgage insurance on top of that as well. It's a completely different dynamic.
So the name is exactly what it is. It's a group of mortgage that's all packaged together, and then you buy a pack of mortgages.
Let's put it into let's put a name to it. Say someone like a Rams, for instance. Rams Mortgage Home Loans. It's probably one of the more well-known mortgage originators outside of the major banks. They would lend money to people wanting to buy houses. Okay, and then they would have facilities in order to fund that, and then over time they would turn that out into the market and they would issue residential mortgage-backed securities. Okay, to investors such as us, and we would choose where to and how to participate. So we would do our due diligence on the originator and the servicer and make sure their track record is fantastic. Make sure we're comfortable with the arrears, make sure we're comfortable with the portfolio. We get all the portfolio in terms of all the loans, where they are, what the loan to value ratio is on those loans,
location,
everything. So you can actually be quite forensic, and we are. And then we make an assessment in terms of where we want to be. And I can tell you most of the assets that we're investing in at the moment are investment grade, whether it be triple B or single A, so very strong investment grade security. and we're getting paid, 350 to 400 basis points in credit margin. So yielding in excess of 4% in some cases. And what you'd need to see for us to be impacted, and these are prime mortgages. So these are the prime mortgages. This is not non-conforming or anything, full employment history, you name it, right? The works. You need to see default rates at 10 times more than the historical peak, right? And you also need to see house prices in capital cities, in Melbourne, Sydney, Brisbane, Adelaide, Perth, decline by 30 to 35% before you're impacted. Now, that to me seems incredibly improbable.
We didn't even get in a pandemic, so
no. And if anything, I sort of thought, as most times this year, that the Melbourne property market, given how badly we've been impacted over the last 6 months, could decline by this time next year by about 10%, 10 to 15, but nothing like what we need to see in order to suffer any kind of impairment. Right? And it's just a great source of return, defensive income for clients.
The other thing that's interesting through this pandemic is that the net saving rate at household level has actually ballooned from about 4%, e.g. each household on average saves 4% of their gross income, to about 25 or 26%. Of course, they're not spending on retail or overseas trips, but it actually puts a lot of mortgages in a better position than they were just 6 months ago.
Absolutely, yeah. And we've got a government that's really stepped up to the plate and provided the support required, which sort of comes back to the quickfire question at the start when we talked about which part of the world is most prospective from our, and it sort of goes towards Australia having the means to kind of support growth and kind of limit the downsides overall.
So how many instruments in your portfolio, Phil? If a client buys in, how many exposures are they getting, and what are the top 2 or 3 biggest exposures that you own?
Yeah, so we've got overall we've got roughly about 40 securities right now.
Yep.
Okay. So yielding roughly about 3.7%, and we're across the whole gamut of Australian credit. So RMBS, ABS, bonds, FRNs, hybrids, effectively, and a bit of private debt. So effectively, wherever we see value, where we think we're getting paid for the risk for the risk that we're taking, there's a fair chance that we'll invest. And we'll do it in a diversified manner, such that you get this kind of diversified blend. The securities are actually sized for the risk that you're taking. So the better the risk, the greater the allocation to the issuer.
That's on a risk return. That's on a risk return perspective, right? So you might see, it's not just on the risk. So you don't hold. No. If you think it's got great risk return characteristics and the market's not pricing it, you'll hold more of that.
Yeah, but we've also got guidelines that we stick to as well, right?
Yeah. Okay.
Yeah.
The fund's liquid as well. So if a client wants to get out of it tomorrow, they can?
Yeah. So daily redemptions are payable in 19 business days. Yep.
Great. And what are the top few holdings? And we've got a few stocks. Let's talk about the actual investments. We've got David Jones, NextDC, and Australian Prime Property Fund, but maybe just start with your largest couple of holdings that you hold at the moment.
Yeah, I'm going to have to...
Or just go straight into those 3 if you like.
Can't remember exactly which one. So David Jones, for instance, and we get a lot of clients who hear about David Jones and they get concerned, quite rightly, because it's a department store retailer and they haven't exactly set the lights out over the past 5 to 10 years. But the important thing to note about the David Jones security is that we only bought in because we're in a senior secured position. We have a mortgage over the property, on a very low LVR. It's currently
Bourke Street, is it? Bourke Street Mall.
So the Bourke Street Mall, Market Street in Sydney, and a distribution centre in Truganina in Victoria, which I doubt many people have been to. I've been to a couple of soccer games, but that's it.
So they fail to pay, you can call, you and the other lenders can call on the assets.
Well, we can take control of the asset and sell them and pay ourselves back. So, the loan to value ratio on that is 35% of the property value. So there's absolutely no issue And that asset is yielding 5.25% and is currently marked at 94 cents in the dollar in the portfolio. So it's not valued appropriately. But here's the clincher, is that David Jones is looking to sell the Market Street store in Sydney. And they've gone into an exclusive charter hold retail on that. Selling that asset would mean that we get paid at par early next year. So we'll get $100 back early next year. So it'll be quite a capital windfall coming from that security.
So you buy it at 94.
Not just the future.
Buy it at 94. If that happens, you'll get $100 back.
Correct.
It's yielding 5.75% per annum on the face value of 100. And that's the type of thing. And if everything went bankrupt, everything went pear-shaped, they would have to sell their assets, and they would have to sell them for you to sustain a loss. They would have to sell their assets at a 70%, say 65% discount for you to lose any money.
And that's just not going to happen.
Yeah,
that's just not going to happen.
So, what rating?
What ratings
is that security?
So the David Jones security we rated with that first lien mortgage, because given that we had security of property, it actually uplifted the rating. So it got up to a BBB minus, which was investment grade.
Investment grade, yeah.
So yielding 5.25% investment grade security. For us, it was once we got that security, it certainly made it more than investable, and it got into the portfolio.
And there are restrictions on what, I think the whole portfolio has to be average investment grade, but you can hold some below.
So we aim for an average investment grade rating. Currently, the portfolio is rated above. So BBB minus is the lowest investment grade rating. The portfolio is actually rated above that. It's rated BBB flat. So it's one notch above that. And it's still managing to yield 3.7%. Despite being relatively high quality. We do have exposure to high yield, and that's roughly around 30% right now. And we have a maximum hard limit of no more than 45% of AUM.
And the difference between a sub and an investment grade company isn't very much, is it? It's just maybe it could be a timing of their review by a credit rating agency, or. Well,
it really depends on what you're looking at. So, some securities can be sub because they're lower down the capital stack, as Jamie talked about before. Some of them might be that they just have a bit more debt, or they're in sectors that are a little bit more volatile. But you just have to be more discerning. You have to be more discerning and just pick the eyes out of that market and make sure that what you are buying, you're comfortable with, that you're getting paid for the risk you're taking, and you've got a very defensive position to defend, right? And you size those securities appropriately, so they generally have less. You have less exposure to those names on an individual basis.
The next one we had here is NextDC.
Yeah, so NextDC is a fantastic story from our perspective. That's one of those issuers that are sub-investment grade, and it's been a fantastic source of return for us. So they're a data distribution centre operator. So they've got all these data centres based around the major capital cities of Australia, where people such as ourselves and maybe yourselves have got server equipment based in their facilities, very specialised. So they've got
like an Amazon or a Microsoft.
It would use their facilities. They would put their server equipment in there because they're guaranteed of no disruptions, effectively. So these are specialised buildings that have got redundancy in relation to power, and also around fire, things like that, to just ensure the security of that equipment. And because of this pandemic as well, I mean, they've actually been a net beneficiary of the pandemic, given all our moves to work from home and the burn in online. It's actually been quite well established, but sort of reinforced by this pandemic. So, in addition to that, they've been heavily building out new facilities and putting them on balance sheet. Now, the reason why they're sub-investment grade is because they're sort of going through this heavy growth phase. So their debt is probably a tad higher than it would be, and the cash flow is growing, but still at a relatively low level. So, long story short, BB rated security, yielding between 3.5% and 4%. And with the callable nature on the bonds have been called now because and the bonds have been called at 101.25. So we've actually picked up $1.25 on the bonds from they've been called early, and we're getting our money back in early December. So on 9th of December, we're getting our money back, and I'm sure they'll come back in some way, shape, or form. Very capable management team. And once again, when that new investment comes on board, we'll look at it on its merits and make sure that we're getting paid for the risk that we're taking, and it's still a credit style security.
Basically, every time they go to market for more equity, they get as much as they want, don't they? To help fund their expansion as well, which is always good from a debt perspective.
Yeah, I mean, the thing about it is during March, April, I mean, we bought NextDC at a 10.8% yield from a distressed seller, and now we're getting $100 back. So we bought it at 92, and we're getting paid $100 on the 9th of December. Right? So unbelievable return. And in addition to that, they went and raised equity to deliver their balance sheet probably 2 weeks after we bought that at 92.
Tell us a bit more about the Australian Prime
Property Fund. Okay, so that's an interesting name. Effectively, you had, obviously with retail, everyone understands in terms of retail property that they've got some structural issues. With the pandemic, that sort of exacerbated a bit. With APPF, also got issues around unlisted unit holders or equity effectively wanting to redeem out of that structure. So what that led to was basically spreads pushing out significantly on the credit, thinking that there was a potential impairment issue. That's not the case. So we are protected by a covenant, an LVR covenant, which prohibits the manager from increasing gearing above 30%. So we're talking about shopping centre assets here, regional and sub-regional shopping centre assets. Now, if you've got an LVR of 30% and the manager can't go above that, then you're protected. You're significantly protected from any kind of impairment. Any impairment that's going to occur, that has occurred in terms of valuations, is borne by equity and equity only. Now, we're getting paid a yield, once again, of akin to roughly around 3.5% on that security for taking virtually no risk. Purely protected by those assets. So certainly, we think there is a process to go through in terms of retail valuations coming back to something akin to the new normal, especially given that a lot of us are buying more stuff online. But none of us are saying that those valuations are going to decline by 70%. Just not going to happen.
Of course.
So the backstory there is it's the industry, a number of industry funds, isn't it? The investors in this, that Lend Lease manages a portfolio on behalf of them, and you've lent.
Yeah.
This security is lent to help fund a portion of that, and they, for some reason, they want to cash up at probably the worst time to sell property since the GFC. Maybe they were overstretched. There's too much unlisted in other parts.
It's the industry funds. It's a rebalance, right?
So equities are falling.
I mean, from that's their perspective, and they make their decisions from the equity perspective. But from us, I mean, we kind of, I won't say put the blinkers on, but kind of be able to separate that from that and understand exactly our position, where the credit sits, and then obviously looking at the return and saying, well, are we getting paid for that risk? Yes, we are. No, we're not.
It reiterates that you as the debt holder are basically in control, doesn't it?
Yeah, in this case, yeah, absolutely, and that's why we've invested. If we weren't in control, or we didn't think that we thought there was any kind of chance of impairment, we wouldn't have invested.
Yeah. Also shows you need to invest when there's opportunities. So the pension funds were constrained because they had to stay within a strategic asset allocation. Obviously, markets fell off substantially, so there was an obligation on them and their trustees to rebalance. A part of that rebalance was to sell down property because it hadn't fallen as far as equities, and that led to natural market opportunities, which gives groups that are more nimble like yours the ability to pounce and buy good investments.
Yeah, and we see that as our competitive strength here. A very large opportunity set, really strong in understanding fundamental research and understanding where value is, and investing accordingly.
Now, we talked about the crisis to now, and how things have kind of come back.
Mhm.
Can we talk about the future? Because we're all invested in your fund, and we want to make some money over the next 12 months. So, what does credit look like over the next 12 months? Do you think?
Look, from our perspective, we see overall saying that credit remains attractive and some segments remain fair. When you look at overall yields being as low as they are, we talked about the cash rate, we talked about term deposit rates, that's only going to be supportive for credit going forward.
Yep.
As a credit manager, I never say no to earning some sort of capital return from spreads declining. I'm very happy when spreads just remain where they are and just keep clipping that carry. And I think the prospect of that going forward is pretty high. If you look at across several segments of the market, whether it be investment grade corporates, high yield names, bank credit, RMBS and ABS, all of them have claims to, at the very least, remain static, if not keep compressing, given the overall spreads, overall yields are so low.
Got it. Do you think the majority of returns will come from income over the next few years?
Well, yeah, I mean, we've seen a fair bit of capital since March, April. You expect that, but yeah, I'd expect over probably going into next year, it's going to be certainly more about income being a driver as spreads compress to a level that they're sustainable.
Yeah.
All right, great, Phil. On behalf of Wattle Partners, all our listeners, Drew and I, thanks for spending the last hour rather than staring at bond screens with us. It's been most enjoyable and hopefully educational for all the listeners. So
it's been very enjoyable. Thank you. Thanks for the opportunity.
No problem. For the listeners, next week we have GQG Partners, a relatively new equity manager. They'll be talking about the resilience of global equities over the last 6 months, and they'll also be talking about what opportunities present themselves in emerging markets. Please join us next Wednesday. Drew, thanks for your time. Phil, thanks for your time.
Thanks, Jamie and Drew. Thank you.
See you guys. Cheers, bye.